Today, the average American needs to earn over $110,000 per year in order to afford a home. That's nearly $30,000 higher than the median family income. And it means that it's rarely, if ever, been as hard to buy a home as it is today. The median home price is now $410,000. And it takes most American families an average of 8 years to save for a 20% down payment, 3 years longer than it took in 1970. The Housing Affordability Index is at its lowest level in nearly 40 years, even lower than it was in 2007, right before the housing bubble burst. And home buyers are feeling it. This chart shows the number of consumers who consider it a good time to buy a home. It shows that public sentiment on home buying is at its worst ever level, with only 17% of respondents saying it's a good time to buy a home. That's significantly worse than even at the peak of the 2008 bubble when it bottomed out at 57%. But the situation today is very different from the 2008 housing collapse, and this chart makes that very clear. It counts the number of foreclosures on US properties since 2005, and this spike here is the 2008 housing bubble bursting. What happened in 2008 was a foreclosure crisis, driven by an unprecedented number of people unable to make their loan payments, causing foreclosure filings to rise almost tenfold. But today, the number of foreclosures is at a historically low level. The issue today is not about people losing their homes. It's about the average person's inability to become a homeowner in the first place. A primary driver of this unaffordability is the rising cost of new mortgages. This chart shows the median monthly mortgage payment for new homeowners by the year they moved in. People who moved in 2014 paid just over $1,400 a month for their mortgage, but people who moved in 2024 paid $2,225 per month, a nearly 60% increase. This is a direct result of rising 30-year mortgage rates, which you can see on this chart. They've gone up from a low of 2.65% in 2021 to over 6% today. However, blaming only high rates is an oversimplification. The record low interest rates we saw after the pandemic are just as much to blame for the current crisis. Those low rates fueled a historic $5.8 trillion in mortgage refinancings, a higher volume than we saw during the 2003 housing boom. This means a massive number of existing homeowners are locked in to very low mortgage rates. With market rates now over 6%, these homeowners are unwilling to sell and give up their relatively cheap mortgages. The result is shown on this chart of existing home sales in the US. After a post-pandemic spike, the number of existing homes available for sale is now near an all-time low, and new home construction is not filling the gap. While there are around 1.3 million new housing starts per month today, the current rate of new construction is below the historical average since the 1950s and has been consistently below average since 2009. Homebuilders were traumatized by the 2008 crisis, where they overbuilt and many went bankrupt, leading to the collapse you see here. Low interest rates during the 2010s boosted home construction over the decade, but that peaked during the pandemic and has slumped since then. Now they face a new problem: rising construction costs, which have risen by an unprecedented 50% since 2020 due to high inflation, making new projects less appealing. The result is that fewer homes are being built than the historical average, and the ones that are built are more expensive, limiting supply and putting upward pressure on prices. There could be some relief on housing prices due to slow population growth. US growth in urbanized population is projected to level off, which could relieve some pressure. But we now face a new fundamental issue: institutional ownership of homes. In 2001, investors owned about 6% of the total US housing market share. In 2025, investors own 20% of US homes. And real estate investors accounted for 33% of home purchases in Q2 2025. That's projected to keep growing too. It's estimated that by 2030, institutions will control 40% of the housing market, or 7.6 million homes. These institutions have a significant advantage over average Americans: billions of dollars in capital. Average Americans, on the other hand, must balance housing against the rising costs of essentials. Since 2020, food prices have jumped 29%, and transportation costs have risen 28%. This squeezes household budgets, and it's had a big impact on Americans' ability to save up for big purchases like a home. This chart shows the personal savings rate relative to income. It plunged to 0.5%, down from over 10% in the 1970s, meaning Americans have less in the bank now than they have since the wake of the 2008 financial crisis. And while cheaper homes selling for less than $100,000 do exist, banks often refuse to finance them. Loan applications below $70,000 face a more than 50% denial rate, nearly double the rejection rate for loans over $150,000. This means affordable affordable housing often requires an all-cash payment, which the people who need these homes cannot provide. This, in turn, allows institutions to scoop up this affordable housing inventory, meaning the average American is being completely sidelined from real estate, a traditional tool for wealth creation. And the situation is very different today than it was in 1970. Not only were homes cheaper in 1970, the dollar also had more buying power. This chart shows the decline in the purchasing power of the US dollar since the 1950s, and it's eroded quite a bit. $1 has lost 88% of its purchasing power since 1970. In contrast, home prices have increased by 16 times in that same period, driven largely by the urban population boom over the past several decades. If the Fed continues to cut rates, as they've begun to do, we could see mortgage rates fall as well, lowering monthly payments and possibly bringing monthly mortgage payments within reason for the average family. At the same time, if the price of construction materials begins to fall closer to pre-pandemic levels, we could see the number of new housing starts begin to rise as houses become cheaper to build. This would increase the supply and potentially reduce the price and down payment necessary to buy a home. However, tariffs on construction materials like soft timber and other home goods are maintaining upwards price pressure on new construction. At Capital.com, we'll keep you posted on the state of the housing market and other trends in real estate. Hit like and subscribe to stay tuned. Thanks for watching.